Current rates, either way, current or proposed, our expenses won't change with the rate changes.
Barring on the insurance cost of their employees, it's going up to $75,000. Now, it's my understanding that the company pays 100% of employees' insurance. Is that correct?
Medical premium, yes.
100%.
So, and that's, find an employer in the country who hasn't seen the medical premium increase. So, but that is.
I understand, but as we get out in the public, it's unusual for someone to get 100% of their insurance premiums paid.
Fully agreed to, yes. So that is kind of the expenses, the budget versus the forecast. So you'll notice that the current forecasted increase is about $500,000 more than what was budgeted. So although there is a budgeted revenue increase, there's also a budgeted expense increase. You'll notice one of our bigger overruns is our professional service fees. We budgeted $8,000 for an audit. We paid $30,000. Okay. Some of those items, there really is.
The 8,000 was based on the previous audit.
Yes. In prior years.
And that's why we easily.
Yes.
What else is in that category? Just out of curiosity.
I remember my first board meeting, we brought up the guy that was working at the state legislature.
The lobbyist.
The lobbyist. There's some in there for that. Now CFO falls into there. We're going into Mr. Pender. It's $30,000 in there. So that's what makes up most of that.
So what you're looking for is all the projections and the numbers in there. You're basically telling the board there's really not any room to give anywhere's what a percent or two anywhere's in that.
Very little. There is room. I mean, this is like this materials budget here. We got $507,000 in the materials. We can defer some inventory purchases. We may save ourselves $40,000, $50,000. But
if we have to defer, the only place you can get any significant dollars is for us to review our program of work of capital projects for this year that are in the 2014 budget and defer some of those projects.
So if we defer,
or a portion of them.
but we defer, all we're asking is kick the can down the road. We have to shut it next year.
Yeah. An example would be the Charleston theater. We got $150,000 budgeted. We haven't spent any of that yet. We could defer all or part of that project to the next year and simply extend the exposure to reliability issues on the facilities that are serving that circuit.
yes.
Could you tell me if the retirement benefits, termination benefits, are they listed under wages? Are they listed under retirement, or are they not listed here?
The termination benefits.
The $500,000 in termination benefits according to financial statements.
They're not listed here because
They're not listed here at all.
They're not. This is not. They're an unfunded expense.
Yeah.
I mean, that's a liability. These are expenses, anticipated expenses forecasted for the year.
What's included in this budget is the service of those who are retired and receiving those benefits this year.
Yes.
They are budgeted.
Well, where are they then?
They're in wages and salaries.
So they are covered in that 2.7.
Those who have retired, yes, they are included in there. But for employee A who has 45 years here,
So
they may
which
retire
is
at the end of the year. We don't know. That's a liability that should be on the books, not an expense that we forecast. Until they retire, that liability doesn't become an expense.
Okay, but which is it then? Are they covered under wages, or
The ones who have retired are included.
already?
But they're gone.
But
Yeah.
they may be included in health insurance costs if they're receiving health
But
insurance
how many people
benefits.
retired this year?
None.
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 Okay, so that's zero then, right?
No, because
It's
we're
covered
paying,
under the
No,
wages?
we're prior year retirees.
we're paying past retirees health insurance benefits.
No, that's covered under another part, okay?
That's
It's not
not
covered
right
under
here,
another
that's
part. This isn't OPEB that we're
Part of the
talking about.
747.
This isn't OPEB that we're
No,
talking about.
No,
This is about the
That is a
unfunded-
liability.
This is the termination benefits, that $500,000, I'll pull it up.
Yes. Well, like I say, it's not an actual expense that
Well,
we
I'm
can't
just wondering, is it
forecast that
unfunded or-
expense.
Is it unfunded or funded?
As a liability, it's unfunded right now.
So if someone comes and retires, where does that money come from? Where do you
Yeah.
take it from?
We have to hit our operating.
You can take it out of operating costs, huh?
You take it out of.
I mean, which cost? Wages? Is that-
Well, if
It's
it's,
probably
if it's employee benefits, it'll come out of this insurance cost employees. If it's a wage that is owed to them, such as a vacation then that would come out of the wages.
So it's different.
Yes, and it would show up and it would hit us. And you would see that when we're looking at the forecast, say, oh, what happened here? Well, Joe retired, so we had to pay him out, right? But until that day, it's not an expense and therefore it won't show up. Now, if Joe was to come to me and say, you know what, I'm retiring on November 1st, immediately, I would fund that liability because I know that come November 1st, I've got to pay that out. And then that expense item would hit here. But what if I was getting hit on the way home tonight? There is an unfunded liability for me that there was no intention ever that Bart Miller would be resigning from this organization effective today. And so it doesn't show up as an expense. So we got to keep these things separate, expenses and liabilities. Do I freely admit that we have unfunded liabilities for OPEB and for vacation sick leave? Oh, yeah. And is that something I want to address in future budgets to start funding that? You darn well better believe I believe that needs to be done. But for right now, we're trying to get through 2014. And this is where we stand as of 2014. And if we're really concerned about a Fitch rating downgrade, without that proposed rate increase that we've asked for, that downgrade will go down further. There is one person in this room who talked with Fitch. And unfortunately, I was not at that meeting when you guys talked about it before. I was the individual who spoke with Fitch. And I'll tell you, whoever individual you spoke with that you've referenced, he was not in on any of those phone calls.
He told me that he was over the two analysts.
He probably was. But I talked with Matthew and the other, I can't even remember the other guy's name. And both those guys, when I was talking to them, they said, you guys are strong. We are a little bit worried about your capital program. Without the rate increases that you said you were going to get 2 years ago, and you have not got, we have no choice but to downgrade you. Now, how would you like us to word it so that it doesn't hit as hard? And so then they wrote it, come back to me, I reviewed it, and I talked with them again on the phone. We tried to get the language as soft as we could. Because our capital program that is required by this community growing like it is, we have to have these rate increases to fund these expenditures. And until we can justifiably meet those requirements, we'll get downgraded again in 2 years. I guarantee you. If we cannot show the rating, because that was Matthew's #1 concern when we come back from the committee meeting. It's like, Art, you guys didn't have a rate increase. You said you were going to. I said, yeah, we got one on the slate for next month. I said, well, good, you're going to need it.
Did he talk to you about using impact fees to help fund the growth, or did he only talk about rate increases?
They won't acknowledge
They-
impact
no.
fees.
And like I say, they were very good, and it's just like Joe's statement. Fitch's official statement was what it was. And when I read it, the first thing I read was without the rate structure going in as it has been proposed, this company's at risk of not being able to fulfill their capital development program, which means the reliability will be hit. Oh, and by the way, there's this governance issue we've had a bad board of director decision made, and we had a bad CFO. Okay, that is how I read it. And when I've worked with them and talked with them, that's what I got. I sat in a meeting with HL&P 2 weeks ago, and they flat out said that if your rating structure does not match what you're proposing in your strategic plans, you're looking at a 30% impact on your rating. That's with HL&P. I don't know Fitch's percentages in there.
And could you give us more information on
I've
that?
asked for that, and once I have it, I'll forward it on because I thought it was very informative information. But yeah, I'm still waiting for that back.
When is S&P going to rate us?
I don't know. They just kind of do the ratings. Right now, they're so focused on getting their municipals done that they're not even considering any utilities, according to what this lady from S&P told me. So, anyways, last slide on this, and then we'll be able to move on to the next item. Just to kind of follow up with what I was saying there. Our 2014 budget showed that we'd have about $600,000 of revenues over expenses to put towards capital projects to keep things moving. You couple that with the impact fees and the aid to construction that we were hoping to get, we could meet our capital expansion program for the year. If we stay with our rates as they are, we'll come up short $114,000. We can't rob from impact fees because they need to go to what they need to go to. Thus, that shortfall is going to have to come out of reserves, it'll have to come out of PPIF, somewhere like that. Hence, we need to tighten our belt, which we're trying to do. I mean, I've already, the fact that we are at the end of May, 2 months into when we were anticipating having the adjusted rates, and we are only missing it by 114,000, and that's pretty good. If we have a warm summer, we'll recover that. We have a cool summer, that could get worse. So that's where we stand, Mr. Chairman. Hopefully that helps you understand.
Yeah, thanks, Mark, for your information.
Would that work against the opposite? If we have a cool summer, it'd be better if we wouldn't use air conditioning.
Well, we use energy. We need the energy to sell the energy.
Yeah.
If it gets hot, people turn those air conditioners on.
It's 24/7.
And the energy's already purchased, so it doesn't really matter, right? So it's not like we
No,
save
we
it.
haven't.
we buy, I mean, but the offset is.
So we don't save money for having a cool summer, it's gonna cost more than if we were to have a hot summer. You're saying it's worse for us to have a cool summer?
It's worse for us to have cool summer because we don't sell that energy.
But then we'd have to buy it either, right?
We don't have to buy it, but we have a markup on it.
Some cases, we've already got it though.
That's what I was
Being
asking.
used.
So, I will send this slide deck out to you. I mean, it's not nothing fancy. And if you want to support behind it, I'm more than happy to provide the support too. It's there to be had. But that's our financial condition. And that doesn't factor in depreciation. If you want to look at it too, it really makes it better.
How often do these guys rate you?
Every 2 years.
So there won't be another rating from Fitch for 2 more years?
Yeah. 2016, I'll get a phone call from them again.
Unless we petition them for minimum financing.
That would be with Fitch, wasn't that?
Yeah, we went to Moody's and Fitch when we did the 2012 bond and when we did the 2010 bond. We continued, we used Fitch and Moody's out of San Francisco for both of those ratings.
Well, the board may have the May financial statements. Any other concerns you have on the financial statements? And then what Mark's presented, pretty good presentations.
They're scheduled for the 25th meeting for, on the agenda for resolution.
So you're not,
As an action item.
so I guess I misunderstood the agenda. We're not looking for approval on this one, not exemptions.
Not until the 25th. That's when we published it for a notice, the public meeting to deal with the regular warrants, financial statements is on the 25th.
So we have an opportunity to look at financials in between them.